Welcome to the Opening Bell Report.
Analysis report for Nebius Group, that's ticker NBIS for the better part of the morning. And honestly, the cognitive dissonance is pretty high here.
Glad to be here. And yeah, it's definitely not your standard growth story.
Right. No, it's not. Usually when we do a deep dive, we're looking for, subtle signals, a 10% margin improvement or a new product launch, maybe a slight shift in consumer sentiment.
We're usually dealing with evolution, not revolution.
Exactly. But this is something else entirely. We are looking at a company reporting revenue growth that, well, it looks like a typo.
It really does.
Over 350% year over year.
350.89% to be exact. And that's just the full year figure. The quarterly acceleration it's even more aggressive.
Right. But here's the contradiction that we need to solve today for you guys listening. On the very day this analysis is being discussed, numbers that would normally send a stock to the moon, the stock actually took a nosedive.
Pretty significant one.
Yeah. It drops 9% in a single trading session down to $97.92. So on one hand, we have what looks like a rocket ship taking off, and on the other, the market is just slamming the sell button.
It feels like a paradox, doesn't it? But that tension, that specific conflict between hyper-growth and what I'd call hyper-skepticism, is exactly why Nebius is the most interesting story in the market right now.
It's fascinating.
It's not just about one company. It's really a stress test for the economics of the entire AI boom. Our mission today is to figure out why Wall Street is betting on a company that is burning cash at what the report calls a catastrophic rate.
So let's set the stage. Who is Nebius? Because if you look at the ticker, it feels like they just appeared out of nowhere to challenge the giants. But that's not really the case, is it?
No, and this is critical context. If this were three guys in a garage in Palo Alto claiming they could spend $20 billion on infrastructure, we'd laugh them out of the room. Nebius is essentially the international assets of Yandex. They were reborn and restructured.
So it's the Google of Russia minus the Russia part.
Effectively, yes. They took the international cloud infrastructure, the data labeling technology, and the engineering talent, which is key here, and spun it out into a NASDAQ-listed entity headquartered in Amsterdam.
And that engineering pedigree matters, right? We aren't talking about a generic startup hiring their first CTO.
It changes the risk profile entirely. These are engineers who have already built search engines, autonomous driving tech and cloud platforms at scale. They know how to wire a data center. And that explains how they've been able to move at the speed we're about to discuss.
Okay, well, let's look at that speed. The report explicitly calls these the insane numbers, and I don't think that's hyperbole. We mentioned the 350% growth. Let's break that down.
So the trailing 12-month revenue, or TTM, is sitting at $529.8 million. A year prior, in fiscal year 2024, that number was just $117.5 million.
That is a massive jump.
It is.
But what caught my eye in the report was the fourth quarter, specifically.
The acceleration.
Yeah, the acceleration. In Q4 of 2025 alone, they pulled in $227.7 million. That is a 547% increase compared to the same quarter the previous year.
Incredible.
547%. I mean, in the SaaS world, we throw a party for 40% growth. This is almost vertical.
It is vertical. And it signals that demand isn't just existing, it is compounding. Which brings us to the ARR, the annualized run rate.
Let's define that really quickly for the listener.
Sure. For those of you who track these metrics, ARR is your best forward-looking indicator of stability. It says if we don't sell another dime's worth of new business but keep exactly what we have right now, this is our expected annual revenue.
And Nebius closed 2025 with an ARR of $1.25 billion.
Which is staggering for a company effectively in its first full year of independent operation. But the nuance here is that they beat their own guidance. They told Wall Street to expect $900 million to $1.1 billion. They blew past the top end of their own range.
So they are under-promising and over-delivering on growth. But, and we have to pivot to the why here, what exactly are they selling? Because you don't get to $1 billion run rate by selling generic web hosting.
No, this is a pure-play AI infrastructure bet. Nebius is building the backbone for training next-generation AI models. We're talking about massive clusters of NVIDIA GPUs, H100s, H200s, and eventually Blackwells. They're building the physical gym where the AI models go to work out.
Now, here is where I get stuck. The report mentions their customer base includes hyperscalers and explicitly name drops Microsoft. They have a massive multi-year contract backlog with them. But Microsoft is Azure. They're the second largest cloud provider on Earth.
Right.
Why on earth is Microsoft renting compute from Nebius? Don't they have their own data centers?
This is the capacity spillover dynamic. And it's the single most important thing to understand about the current market. Yes, Microsoft has Azure. But the demand for AI training capacity is so explosive that even the hyperscalers cannot build data centers fast enough to meet their own internal needs, let alone their customers' needs.
So Nebius is basically the overflow valve.
Exactly. Yeah. When Microsoft or an AI native startup needs 10,000 GPUs today to train a model and Azure is booked solid or waiting on chips. Nebius says we have the capacity live right now. Being a neutral cloud provider, one that doesn't compete with you on the model side, is actually a massive strategic advantage here.
They are Switzerland. They have the guns, but they aren't fighting the war.
Precisely. And Arkady Veloz, the CEO, has been very clear about this vision. He believes the demand for compute is going to outstrip supply for years as use cases multiply. They're scaling purely to capture that gap.
Okay, so the growth is real, the demand is real, and the customers are titans of industry.
Yeah.
So why did the stock drop 9% in a single day? Why is the market terrified?
Because building the Switzerland of AI is excruciatingly expensive. The bear case. The bear case. And it's not a subtle one. The report uses the word catastrophic to describe the cash burn. And financially speaking, they aren't wrong.
I saw the free cash flow number, negative $3.68 billion.
Right. They are bleeding nearly $4 billion to generate that growth. But there is a specific metric in the analysis that really highlights the risk profile here. It's the ratio of capital expenditure to sales.
The $7 insight.
Yes. Right now, for every single dollar of revenue Nebius generates, they are spending roughly $7 on capital expenditure.
7 to 1. Now, if this were a software company, we'd say the business model is entirely broken. You can't spend $7 to make $1 in sauce.
Correct. But Nebius isn't a SaaS company, and treating it like one is a mistake. This is an infrastructure play. Think of it less like writing code and more like a utility company laying fiber optic cables across the Atlantic, or a railroad laying track in the 1800s.
Okay, I see the parallel. You have to spend billions digging the trenches and laying the fiber before you can charge anyone for the internet connection.
Exactly. The upfront capex is massive, but once the track is laid, it becomes an annuity machine. The problem, and the reason the market punished the stock, is the sheer scale of the bet. Their core operating income is negative $596.2 million. They're incinerating cash to build this capacity.
And unlike a railroad track, which lasts for 50 years, these GPUs have a shelf life, don't they? That seems like a risk that isn't talked about enough.
That is the depreciation risk, and it's the dark cloud hanging over this whole sector. If Nebius spends billions on NVIDIA H100s today, and NVIDIA releases a chip that is twice as fast and half the price next year, the value of that inventory drops like a rock.
It's the melting ice cube problem. You are spending billions on an asset that is actively getting worse every day.
Which puts immense pressure on utilization. You have to rent those chips out 247 immediately to pay them off before they become obsolete. That's why that 46x price to sales valuation is so scary to some investors.
46 times sales.
Yes. The stock is priced for perfection. Any delay, a construction halt, a power grid issue, a slowdown in client onboarding, and the math stops working very quickly.
So investors see the negative billions, they see the depreciation risk, and they hit sell. But the analysts, the report says the consensus is still bullish.
Heavily bullish. Price targets are in the $143 to $150 range, which implies a 45% upside from here.
So what is the 2026 gamble? What is the light at the end of this very expensive tunnel?
The gamble is that we are in a land grab phase where the only thing that matters is scale. If you secure the power and the chips now, you win. If you wait for the economics to make perfect sense, you lose. Wall Street is betting the cash burn is a temporary phase to secure dominance.
And when we say scale, we aren't just throwing that word around. The projected capital expenditure for 2026 is eye-watering.
It is. They plan to lift 2026 capex to between $16 billion and $20 billion.
$20 billion in 1 year.
To put that in perspective, that is comparable to the capital spending of massive established global sovereigns or oil majors. For a company of this size, it is an absolute all-in bet.
And what does $20 billion buy you exactly?
It buys you the scarcest resource on the planet right now, which is power. The report mentions they are aiming to secure over 1 gigawatt of power capacity.
Okay, for the non-electrical engineers listening, 1 gigawatt that's a lot, right?
It's massive. That's enough energy to power a city the size of San Francisco, or a significant chunk of a small country. We tend to think of the cloud as this ethereal thing, but it's actually industrial-scale warehouses filled with silicon that gets incredibly hot.
So it's mostly cooling.
A huge part of it is. Securing 1 gigawatt of power means grid connections, substations, advanced cooling. It is a logistical feat that takes years to set up.
So if they pull this off, if they spend the $20 billion, build the data centers and plug in the GPUs, what do the numbers look like on the other side?
That's the payoff. Compare the 2025 actuals to the 2026 projections. If they execute, revenue is projected to jump from that $529.8 million we saw today to somewhere between $3.0 billion and $3.4 billion in 2026.
That's roughly a 6x revenue jump.
And the annualized run rate is projected to hit $7.0 billion to $9.0 billion.
From $1.25 billion to up to $9 billion in 2 years.
Exactly. That is the kind of growth that makes Wall Street forgive the cash burn. If you can prove that for every $7 you spend, Now you're building a machine that generates $9 billion a year in high-margin compute rental. Later, the math works out.
It effectively creates a money-printing machine, assuming the demand holds up.
Big assumption, but yes, that is the thesis.
Let's synthesize this because it brings me to a thought about the broader market structure. Nebius is really a test case for the entire AI industry right now. It's a race to build capacity before the demand shifts. But we're talking about a world where you need to spend $20 billion just to sit at the table.
The table stakes have been raised significantly, yes.
It makes me wonder about the moat. We talk about economic moats all the time in these deep dives. Network effects, brand loyalty. But isn't cash the ultimate moat here?
It's certainly becoming that way. The capital barrier is immense.
I mean, if Nebius is successful, doesn't this signal the end of the startup era in AI infrastructure?
That's the provocative question, isn't it?
Yeah, I want you, as the listener, to think about this. If the barrier to entry is 1 gigawatt of power and $20 billion in liquidity, who else can possibly enter this market? Are we watching the door close behind the megacore?
I think we are. We're seeing a real bifurcation. You have the application layer, the people writing the software where two guys in a garage can still innovate and compete, but the infrastructure layer, that is becoming a game for sovereigns and megacorporations only.
It's almost a return to the industrial age. You can't launch a rival railroad from your basement.
Exactly. And Nebius is betting that by the time the dust settles, there will only be 4 or 5 players on Earth capable of training the largest models. They fully intend to be one of them.
So the takeaway for everyone listening today is clear. Nebius is a high-risk, high-reward play where insane growth requires insane spending, but it's also a proxy for the physical reality of AI. It's expensive, it's power-hungry, and it's moving faster than anything we've ever seen.
And it's a reminder that in this phase of this cycle, profits are secondary to possession. Possessing the power, possessing the chips. The profits are a problem for 2027.
A problem for future us. Well, we will be watching that $20 billion spend very closely. Thanks for diving deep with us today.
Always a pleasure.
Don't forget to like, share, and subscribe for more.